You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Michael Fritzell. Michael, thank you so much for being on the podcast. It is awesome to have you here. We're here to talk about. Yep, it's awesome, and we're here to talk about Asian stocks. But before we get started, could you just give the audience a bit about your background and what you do, and really, how did you end up in Singapore?
Well, okay, so those are a few questions, but right now I run a Substack called Asian Century Stocks, which focuses on primarily value stocks in the Asia Pacific. But I'm personally Swedish, born in Switzerland, outside of Geneva, but I grew up in Sweden, in Northern Europe. And after working in the UK for a few years after graduation in investment banking, I moved to Asia in 2009. And initially, I studied Chinese. I didn't really know what I was doing, frankly, career-wise. But then I got a job in fund management in China, working out of Shanghai as a research analyst. And at that time, I was covering mostly Hong Kong-listed stocks. But over time, I also covered more A shares using a QFI license. The company I was working for raised an A share fund. So I also covered mainland listed Chinese stocks, and over time also a lot of focus on Korea and Southeast Asia. Since 2014, I've covered more Southeast Asian markets. Those would be Indonesia, Malaysia, Thailand, Vietnam, and also Singapore, of course. I initially came to Singapore working for a family office, so they gave me an offer to work for them, manage their Asian portfolio based here out of Singapore, and pretty much stayed. I had a few different jobs since then. Most recently, working for a European mutual fund complex as kind of a research analyst. And since April this year, I've basically gone over to Substack completely, and I do deep dives on Asian value stocks, basically. That's what I do.
That's awesome. And what sort of overall, what would you say is the case for Asian stocks? So you usually talk on Twitter, you talk a lot about the case for Asian stocks as relatively speaking to U.S. stocks better than American equity. So what's sort of the case for Asian stocks and what makes them attractive to you?
Well, it's a broad market. There are many different opportunities that have different drivers. But generally speaking, they are quite inexpensive. Even in this region, I'm based in Singapore, people around me are investing in cryptocurrencies and US tech stocks. That's pretty much what everyone is interested in at the moment. And that was not the case 8 years ago or 5 years ago even. So there's been a shift away from the region, and that caused, I think, the valuation multiples to become really depressed. And I think that's the opportunity. You can buy stocks with very decent margin of safety, like high quality consumer stocks for low teens PE multiple. To me, that's quite attractive. Like that was not the case 5 years ago. They were trading at 30 times earnings. So in comparison to those more popular stocks, I think especially tech, I guess Chinese tech was popular early this year. I think the risk reward is quite good if you're long term. So that's pretty much the case. I mean, other than that, I'm not sure. Like each country has its own dynamics, and the region is, it is growing. Like there is economic growth, but I'm not sure how much that really matters for stock prices. Like China has had amazing growth over the past 30 years, but the index has not really done all that well, and it's been quite difficult market to invest in. So I don't pay too much attention to that, but there are for sure very high quality businesses in the region that you can buy for very cheap multiples, actually.
Got it. And moving on, on your Substack, you've talked a lot about food companies like restaurant chains and soy sauce producers like Sempio in Korea. So what are the economics of Asian food companies? How do they work, and what are the dynamics that drive them?
I think generally speaking, food companies, they do have pricing power. There is limited competition. For example, you mentioned Sempio. They have a 60% market share in soy sauce. Like, their brand name is dominating in Korea. So that's a pretty strong position to be in. And I do think that the world is facing inflation pressures, and companies that do have pricing power should be able to maintain or even increase margins as inflation pressures build. So, I mean, the economics are strong, and that's the short answer. Of course, most recently, I think they are down quite a bit because of rising food prices. In Sempio's case, that's soybean prices have gone up a lot. But also, I own Ultra Jaya in Indonesia. Like, raw milk prices have gone up a lot. And they can also hurt from time to time, they can be hurt by currency movements. But these are really short-term issues. And over long term, they tend to have high margins and high returns on capital, generally speaking.
And as you mentioned Indonesia, you've talked a bit about Indonesia, about the Indonesian property markets. What does the Indonesian property market look like? How does it work? So could you sort of give a primer on Indonesian property?
Sure. I think it's a extremely interesting market in terms of where it is in its development path. If you go to a city in Jakarta, or like a city in Indonesia, like Jakarta or Surabaya, they don't have many high rises.
Mm-hmm.
So the landscape, like the way that a city looks like in Indonesia, is totally different from a Chinese city, which
Mm-hmm.
is predominantly built with the high rises. And there are reasons for this. Historically, it's been difficult for developers to buy land, to accumulate land. There have been different registries on a local level and on a central level, which make it difficult to acquire land. You would have all these sorts of conflicts that have to be settled somehow in court. And what you ended up with is a number of developers holding land and just sitting on it. And those are the developers that are listed as well. And out of this we've had like townships being built by each of these major developers, which are basically like cities. And they also provide their own shopping malls and office space and so on within the townships. But I think that's going to change a little bit, at least. There's a new law that came into effect last year, the so-called omnibus law, which is going to make land acquisition easier. And in the future, I think over time, it's not going to happen immediately, but over time, we're going to see a lot more high rises in Indonesia. And there's one company, in particular, that's going to benefit from this trend, I believe, called Pakivon. But generally, there's not much construction. Like, most housing is subpar, and the construction in square meters per capita is very low. Like in Indonesia, I don't recall the exact number, but it's got to be like 0.2 or 0.3 square meters per capita versus China's 1.8. Like, it's a multiple. Like, China is just building way too much, and Indonesia is far behind. So that's the long-term picture, and that's broadly positive. And then you also have right now, it's booming. The property market is booming, like you wouldn't believe. I think prices are up 35%, something like that, year on year.
Wow.
And it's been a very tough market for the past 6-7, I guess, since 2014, roughly. So prices have not been rising. I think contract sales have been weak, but this year has been amazing. And when you see these kind of price rises, that does wonders for margins. So short term, Even though I don't personally own any Indonesian property developer, the fundamentals are just fantastic, and it's partly driven by the government policy. They've they've reduced mortgage rates or interest rates. They've begun with QE, which has been that's been okay so far. Anyway, the government is really supporting the property markets in various ways, and we're seeing that in the actual data. So to summarize, it's a very undeveloped market. It's very with almost no high-risk construction, but it's going to change slowly, and in the short term, fundamentals are just fantastic.
Awesome. And you've also talked about other parts of just general Indonesia. You've talked about milk companies in Indonesia. You've talked about beer companies in Indonesia. So is there anything in particular just about Indonesia, that makes it special, that makes it great or ripe for investment?
Yes. Okay. So generally speaking, so what happened since the pandemic is East Asia markets like Korea, Taiwan, and to some extent China has done very well. And the reason is that they export goods. And during the pandemic, especially in the United States, there's been cash handouts, and people have been spending that money on goods. Essentially, they shifted the consumption from services to goods, and that has really benefited, especially these tech or manufactured goods exports, and especially technology products. That's why these markets have done so well, especially Taiwan and Korea. So that's the broad picture. Japan as well. That's the broad picture. It's more south, in Southeast Asia, these markets have not done well. Like Thailand has suffered from the lack of tourism. Same with Bali. These countries have suffered greatly in various ways. So that's the broad picture. And more recently, then in this summer, there was a big Delta wave. First in India, and then in Indonesia, to some extent also Malaysia, Philippines. That was brutal, and they had to have lockdowns, and it's been extremely bad for these small businesses which don't have access to bank financing and so on. So that's the broad picture, and that's why these stocks are so cheap, I think. So I'm not a person who only invests in consumer goods, but it just happens to be the case that they're quite cheap. So like, for example, if you're talking about tobacco, I think these multiples, we haven't seen them for a long time. Maybe Malaysian tobacco is a special case, but even Indonesian tobacco companies are very cheap. And the beer company that I pitched, Multi Bintang, it's trading at a normalized multiple of something like 12 times earnings, and they pay out 100% of their earnings in dividends.
Wow.
So you can guess you're going to get high dividends as long as as the world recovers from COVID-19. So that's the broad picture. The undervaluation is extreme in Southeast Asia, whereas East Asia not so much. Only in certain sectors, such as these experience based services, such as cinemas, transport, and so on. Those are undervalued. But broadly speaking, Southeast Asia is where you find the greatest opportunities right now.
Got it. And when you speak about East Asia, could you talk a little bit about what the East Asian development model sort of looks like? How they've sort of grown in a way that most other countries haven't grown, and they've grown really fast, and they have a unique model to grow. So could you talk a little bit about that? And then after that, we can get a little bit into banks in Asia as well, and how they work. So just wanted to get your thoughts on East. Yep.
Okay, so East Asia has developed extremely well,
yep.
like remarkably so. And Japan, I suppose, was the first to reach developed market incomes, followed by Korea and Taiwan.
Mm-hmm.
And they benefited through manufactured goods exports, basically outsourcing of Western companies to these markets, and slowly these companies have built up their own brand names, or local companies have somehow got benefited from technological transfer of know-how, a transfer of technological know-how, and eventually these companies export their own goods with their own brand names and take market share. So we've seen that with Sony, Samsung, and a variety of such companies. So that's the broad model. And what governments have done is, first of all, they have an educated population. That's something we've seen across East Asia. And then also they've subsidized exporters through various ways,
Right.
and directed lending to exporters, which has been a successful strategy because this transfer of technological know-how justifies, apparently. I mean, they've been able to increase productivity that way. So that's basically the story, broadly speaking. And China has also done the same since 1978 or so. Although now perhaps we're seeing a more focus on self-reliance and then going back to state-owned, state-owned capitalism.
Yep. And so, when you talk about sort of bank financing in Asia, just generally speaking, banks in Asia. So how do they work? And, in terms of the variables, what actually drives, the profits of these banks?
Well, I think generally speaking, banks in Southeast Asia tend to be a lot more profitable, like in Indonesia and India, or maybe like Pakistan. And the reason for that is because inflation rates are high, and typically deposit rates tend to be quite low. I mean, around zero. And if overall interest rates go down as well, it will become more difficult for banks to earn a fat net profit margin. So typically you will want to invest in these markets with fat net profit margins, and those will be India, Indonesia, and other frontier markets, or let's say poorer emerging markets. In East Asia, though, now in Japan and increasingly Korea, China, the overall interest rate environment has become, the interest rates have fallen so much that it's become difficult for banks to earn fat profit margins. And in some cases, like Singapore has a also low interest rate environment, but then the banks are pretty much in an oligopoly. There are only a few banks to choose from, and they are, let's say, protected by the government, so they can survive pretty well. But that's not the case in Japan, for example. Like these banks are not particularly profitable. So in terms of investing in banks, I would look into these markets like Indonesia, India, Pakistan. So.
Got it. And so, in terms of other opportunities in Asia, just generally speaking, where else do you see, the best places for investment? So, we've talked about, Indonesia, we've talked about, the banks in general, we've talked about Korea and, some IPO, stuff like that. So, where else do you see opportunity right now in Asia?
I think one theme is ESG. So just like in Western countries, there's been a great focus on ESG factors. And if you look at sell-side reports today, they often quote how a company scores in these key ESG dimensions. That's I think that's the reason why some of these non-ESG compliant names have become really cheap. And in my own portfolio, I've invested in tobacco, alcohol, and I think it's not a coincidence. It's just the fact that people don't really want to touch them, and it's the same with palm oil. So that's to me that's a really interesting theme. Non-ESG compliant stocks. I think coal stocks, maybe Indonesia, they look very inexpensive. Maybe they aren't. Maybe they're not that high quality. Like competition is quite high in these commodity industries. But so that's what I think. That's one interesting thing. Another interesting theme is Chinese SOEs. So US sanctions from 2020 have really hurt the prices of these SOEs, and especially in the H-share market, like the Hong Kong listed Chinese SOEs. So that's an interesting theme. It reminds me a little bit of Russia in 2014, 15, after US sanctions on Russia, and I think that was after the Crimea crisis. They became extremely cheap. And today we're seeing similar types of low multiples as we saw back then for Russian stocks. So you can buy a seaport for like 5 times earnings in China, growing, like container port with strong franchise. You can buy like the telcos traded like 7 times earnings, 7% yield, 7-8% yield, which is pretty attractive. But it's really across the board, and typically for these SOEs you pay about 4, 5, 6, 7 times earnings roughly. It used to be 10 or 12 times earnings, so you can double your money if you believe that they will re-rate. And of course the reason is US sanctions. US investors cannot own Chinese military-linked companies, and maybe that won't change, but at least the selling pressure is going to abate. So we've seen selling pressure from mid-2020, and it's already been almost 1.5 years now. So I think that selling pressure is pretty much over. And it's hard to say exactly when they will re-rate, but I think that's a very interesting theme. And then I think the third large theme is COVID-19, and what I invest in is completely bullish in terms of a recovery from COVID-19. And maybe people don't agree with me, but at least if you believe that our consumption patterns would normalize, there are so many stocks to invest in. Like there are so many stocks that have hurt. They've been suffering from COVID-19 and may recover. And those, broadly speaking, those would be the tourism industry, like airports, railways, basically transport industries. Also, like there's a company in Singapore called SBS Transit. It's also a railway operator.
Yep.
So transport is one theme. Another theme is restaurants and bars. Like in Japan, the foot traffic to restaurants have been weak, and I would say it's still going to be weak for still another few months due to Omicron. But that's for sure a super interesting theme, and these stocks tend to have at least 50% upside, almost across the board. And then of course there are other related companies like karaoke bar operators, ski resorts, gyms, and in the REIT sector, especially hospitality REITs have been suffering due to a lack of tourism. The borders have been closed. So that's the theme. And right now, I was a little bit worried about Omicron, but to be honest, the evidence so far seems to indicate that it's highly transmissible, but pretty mild. So I think you got to be bullish about these COVID-19 recovery plays. I certainly am.
Got it. Awesome. And moving on, I wanted to ask you, when people generally think of Asia, they usually think of one, shoddy regulation, poor accounting, stuff like that. So especially when you look at smaller companies, how do you check and verify for accounting? And just generally speaking, how do you ensure that the accounting and the numbers aren't made up?
Well, I think it's pattern recognition, generally speaking, and yeah, that's typically what it is. Experience tells you where the risks are greater, and in smaller companies, for example, in Hong Kong and China, the risks are just greater, especially private companies. SOEs tend to have quite reliable accounting. not particularly dynamic, perhaps, but also they're not going to turn out to be complete frauds, as we've seen so often with the Chinese companies. But then, of course, in the accounting, you can also spot red flags. And one red flag is when the margins are just completely exaggerated for no good reason. I will want to dig deeper. I can think of so many examples right now. You're never going to get like a complete proof that this company is having fraudulent accounting, but that's certainly something I would look for. If all other companies in the sector, if the company is producing something like steel pipes and they're making 25% margins on that, something is fishy.
Yeah.
For a lot of these large caps, you will have short sellers, commenting on them at some point. So make sure that there's no obvious warning signs. Like just search for whatever has been written in the past. I'm talking about Chinese companies in particular. And then I think other than that, I mean, looking at the cash flow statement makes sense. Looking at whether they actually produce free cash flows or not, or whether there's a shortfall, whether the balance sheet is growing very fast, much faster than the overall business. That could be a warning sign, a sign of that they're manipulating earnings. And then dig deeper into exactly why is the balance sheet growing so fast? Like, are they buying up related companies or something like that? And there are a few other tricks you can use, like looking at the tax paid and so on. But I mean, for me, like in the past year or 2 years, I haven't really invested much in public companies in China, or for the matter in Hong Kong or Singapore. I've stayed to very blue chip names, and you're not going to go that wrong if you invest in like a blue chip stock in Southeast Asia, like Multibintang. It's not a fraud. It's not a fraud. But if you invest in a small cap concept stock on Nasdaq with almost no revenues, you're taking much greater risks. So yeah, long answer.
Yeah. Yep. And so when you use your pattern recognition and identify that there's some company that's actually making up the numbers, do you ever actually go short the company? And so, if so, from like a long short portfolio construction standpoint, is there like an optimal short exposure percent that you have in mind when trying to construct that kind of portfolio?
Well, I've done a lot of backtest on this, and I think a good strategy is to just focus on IPOs, like recent IPOs, because they tend to push the story pretty hard, and there's a clear catalyst because the IPO itself is the catalyst.
Yep.
A lot of times after the company's listed, the management team will kind of just give up. They've raised the capital, and they won't be as interested in maintaining the story anymore or meeting investors. So I think that's a pretty good strategy. In terms of the exact like net long position that you want to keep, I don't know about that. That's a macro call, and I'm not particularly good at that. But I would guess though, like with this kind of inflation that we're seeing, with money supply going up 40% in 2 years,
yep,
I think you probably want to be net long. I don't see why, what the point is of trying to maintain zero, net exposure. Basically, stocks. The point of investing in stocks is that you can hedge yourself against inflation. It's the same with property, and so if you're not interested in investing in bonds, then why would you be so interested in maintaining zero net exposure? I don't really understand that. I mean, other than perhaps if you're really bearish on the market or if you're really good at spotting shorts. But yeah, go for recent IPOs.
Yep.
And I guess also be contrarian.
Yep. And yeah, when you for a particular stock, how does one figure out which variables really matter and which variables don't matter? So how do you figure out, what to focus on when it comes to picking particular stocks?
Well, one thing you can do is you go back into the MD&A section of previous annual report.
Mm-hmm.
If you go back 10 years and you see exactly what they comment on,
Mm-hmm.
you will pretty much know what the drivers are. And I think with experience, as well what the key factors to look for are. I mean, I think that's something you learn from just reading, from focusing on particular industries. And if you read prior write-ups on VIC or other platforms, or on Substacks, you will know pretty much what they talk about. For example, for tobacco, regulation matters a lot. Or for tech stocks, new innovation really matters. So you will have to look at competitors' products and see what they are, how they're innovating. Or for tobacco, you will have to know exactly what the government wants to achieve.
Yep.
Another way is to, if you get access to sell-side research and especially sell-side models,
Mm-hmm.
look at the models, like what's driving the revenue line, or whatever, whichever way they model the financials, because that can give you a clue. Obviously, for example, for oil and gas company, you will want to know volumes and also prices and how much they hedge and so on. That becomes pretty obvious once you go through the model.
Mm-hmm. Yep. And you've sort of focused your investing efforts in Asia. So from interacting with people who invest in the US, or just in general, knowing what stocks are like in the US, how is value investing in Asia different from that in the US, especially in terms of building a process? What do you do or what do you not do that a US equity investor does?
Well, first of all, I think this mindset that the capital just compounds in a company, it's not that easy. Like, maybe it will. Maybe if the management team is rational and really looking at minority shareholders. But in Asia, most private companies are family owned. They're looking after the interests of the family. So it becomes inherently more speculative to bet on them. You can't just discount cash flows and calculate the cash flows and expect all those cash flows to come your way. In some cases you can, perhaps, but I think investing in these markets is inherently more speculative, and you can try to find better cases in terms of corporate governance, but corporate governance is far weaker. So you got to be more careful and more speculative. So I guess I'm also more cynical. I don't expect companies to just perform amazingly over time. I will trade in and out. So if my consumer stocks like Delphi, if that goes up to 30 times earnings, I will sell, no doubt. Whereas if you own Disney, for example, perhaps that's a stock you will want to own forever. So value is, yeah, I do look for value, but that's mostly because I want to front run other investors.
Yep.
That's my mindset. It's not so much that I believe that you will actually necessarily see those cash flows, although I hope for that as well. But yep, I buy them cheap, hope for a re-rating, and then I buy something else.
Got it. And yep. And then moving on, one thing that you cannot just talk to an Asian value investor or like an Asian investor and not talk about China. So I wanted to get your thoughts on the recent sort of bust in Chinese tech, and what are your thoughts on it, and how are you thinking about it?
I don't know. Like, I don't know what's going on, and I think it's pretty naive to think that like anyone knows what goes through the mind of the people in Zhongnanhai.
Mm-hmm.
Like, who knows what Xi Jinping's goal is?
Yeah.
Who knows? It's just unknowable. So unless you're one of those 10 people, unless you're one of those few people who have insights into his long-term plans, you be a bit careful. But I can tell you this: like, next year is going to be a leadership transition, and Xi Jinping he's been trying to achieve a third term for himself, and I think that he wants to achieve reinstate the role of chairman of the Communist Party, which hasn't been used since the Mao period. And if he becomes a leader for life, if he achieves that, there will be less need for him to crack down on the private sector. So in the past, after he came to power 2012-13, he has been having an anti-corruption campaign to weed out opposition within the party. And more recently, the past 2 years, he's been extending that anti-corruption campaign in the private sector. And that's going to last for a few years. And who knows where we're going to end up after that. Maybe, in the best case scenario, things will go back to normal, and the people running companies in the private sector are all allied with the leadership, and they will be investable again. In a worst case scenario, we will go towards some kind of state ownership across the board. I mean, maybe that sounds extreme, but that could happen. I think a key power base of Xi is leftists, the leftist faction, a very leftist faction of the Communist Party. So it's highly possible that we go back to, these reforms that have been made since 1978 to 1981. If they're being undone, it's possible that we'll go back to a lot more state ownership again. So that I'm waiting for clarity. Like, I want this crackdown to end, and maybe then you can invest in some of these companies. But it's highly concerning that they're being forced to pay or invest 100 billion RMB in Alibaba's and Tencent's case for social purposes. Like, you're not really a shareholder at all, are you? As a minority shareholder, like,
Yeah. Yep.
Yeah, it's mind blowing. So I'm keeping away. I prefer state-owned enterprises because they are aligned, and I think also the government, they like to receive dividends. So I think they will continue paying out 30-40% of their earnings as dividends.
Yep.
So yeah.
Yeah, and when you think about Xi, you sort of think about political risk. And so, how do you account for political risk in other parts of Asia where you invest, say Indonesia, Malaysia, etc.? So there's still political risk that's very prevalent. So how do you think about it, or how do you account for it?
I don't think political risk really matters that much, other than in extreme cases. Of course, in 1949 in China, political risk mattered a lot because all private assets were expropriated by the government eventually. But in Southeast Asia, it hasn't really mattered that much. Even if you have a change in leadership, be it Thailand or Philippines, it hasn't really changed the fundamentals all that much for these leading business groups or families. So I wouldn't worry about it too much. I suppose it is interesting to know where a family sits in terms of their connections with the leadership. But these smart tycoons, like the Chanamanond family in Thailand, they cultivate relationship with every politician. So I haven't really seen any reason to worry about politics too much in Southeast Asia. It's more about communism. Typically, in the past, I wrote a post on how to invest during a war. I'm not sure if you read that. Like, the main gist of that article or post is that you want to avoid communism, and you want to avoid countries that become occupied by foreign nations. Basically, those are the two circumstances in which stocks can go to zero. And other than that, I think just invest in a good company and you'll be fine.
Yep. And going back to China, what are your thoughts on the housing market? I think you've called the housing market unbalanced, right? So with the whole Evergrande, crisis or event, what are your thoughts on the Chinese housing market?
Well, they're building too much. They're building too much. Like they're building something like 23, 25 million units per year, and there's demand for maybe 10, maybe 12. The completions is about 12 million units per year, and the new starts is about 20, over 20. So clearly they're building way too much, and I'm not sure exactly what happens to all these units that are being built. They're being accumulated somehow on someone's balance sheet. And obviously, Evergrande is one company that has accumulated a lot of assets on its balance sheet. From time to time, it's been able to sell some of that inventory, but essentially, it's been relying on bank financing through it's had good political connections in the past, and it's built up a lot of debt, building apartments that people don't really want, to be honest, especially in lower tier cities. So that's the broad picture, this excess construction, and I think the government doesn't really know what to do with it. Another theme is well, I guess I can talk about what happened over the past year. The government seems to have had enough. 2015-16, there was this so-called supply side reform, whereby the government, they subsidized the purchase of these excess inventory. So if your house was displaced in a redevelopment, you received cash handouts. I think it was channeled through China Development Bank and the other development banks, and it had the effect of creating a boom in housing purchases in 2016-17, and that reduced overall inventory. But the problem is still there. Like this, they're building too many apartments, more than was actually needed. So that continues to be the case, and now there seems to be, there are two ways to interpret what's going on. One way is that the government is fed up with this excess construction and this lending to these companies, and they basically ordered banks to stop lending to Evergrande, which caused a bust. And now Evergrande is going to be taken over by the government, most likely. So the banks are able to lend to SOE developers, which are going to pick up the carcasses of Evergrande and other developers. So that's one that's one theory of what's going on. Like they want to reduce excess construction. Another take on it is that Evergrande has been associated with Wen Jiabao, like it's been part owned by his family, and he is in clear opposition to Xi Jinping, and there might be a turf war. Like he might be targeting Evergrande as a way to target opposition, because as you know, as we said, he's trying to garner. Yeah, he wants to cement his position as hopefully as chairman of the CCP over the next year, leader for life. So that could be what is going on here. So who knows what happens in the future? Most likely, I think the state-owned developers will take a larger share, over time. We've already seen consolidation over the past 5, 6, 7, 8 years in the industry, and that's going to continue. So perhaps at some point, the entire industry will be state-owned. I think that's possible. And perhaps then this over-construction problem will be dealt with.
Yep. So far, we've sort of talked about industry dynamics and, specific stock dynamics, etc. So when it comes to management, as you've mentioned, a lot of these companies tend to be family owned and family run. So what are the common characteristics of successful CEOs?
I think it depends a little bit. So depends on what industry you're in. But like if you're a tech CEO, you want to be really product focused, and if you're running a commodity company, you probably want to be focused on reducing costs, like being very active and operationally focused. I mean, so that's yeah, it depends, but also have to be able to navigate politics. I think that really matters for these smaller markets, because frankly, a lot of these Southeast Asian markets, they're controlled by a number of families, and you have to play politics. You have to have access to bank financing. And typically, like, for example, if you take Philippines as an example, I think that most of these banks, the big banks, they're controlled by certain families. And if you don't have access, if you're not close to one of these families, you don't have access to bank financing. So cultivating a relationship is another key factor for surviving. And then for minority shareholder, obviously you want to see that they're allocating capital in a clever way. Share buybacks are really unusual in the region, but at least you want to see them pay out dividends, at least for companies that don't require capital to be reinvested. You will want to see dividends. So that's, but it's a good question. I mean, I'm not sure if I can really identify a good manager. Yeah, it's a tricky one. And right now I'm running my Substack full time. I don't have access to these people. So it's tricky. If you do have access, you'll be able to figure out what that person is focusing on. Like, what is he focusing on most of his hours? Is it M&A? That's a very difficult way to grow. Or is he trying to think of what's the best for the customer? In industries that are not commoditized, that's a very good sign, obviously. So yeah, I guess it depends.
Right. And when it comes, so let's say, you want to learn everything about the Indonesian property market. So what does the research process look like for, trying to understand these specific niches in the market? How do you get started? What are the questions you ask? And, how do you actually go about, researching? I guess it's more unconventional because more people. If I have to research Apple, it's a little more straightforward. But if I have to research, say, Indonesian property, it's not as straightforward as it is, right? So, what does your research process actually look like, for investigating these? I guess you could call it niches.
Well, I have checklists, and these checklists include things like long-term trends in regulation, technology, consumer patterns, like consumption patterns. So I will want to know all of these trends, for example, in the industry. And the sources I will use are, frankly, a lot of times it's from the sell side. Sell side has a lot of good research. And now you can access it through maybe Substacks, including my own. But I'm still relying on sell side research, to be honest. In some cases, you can find good reporting from news articles, but you still have to piece together everything yourself. And then in some cases, companies themselves will have good reporting. So if you go to Ciputra, the Indonesian developer, if you go to their website, they have a presentation there where they also talk about the market. So that could be helpful. And they also talk in the earnings call, they will also talk about the overall industry. So there's no good way, but other than just absorbing as much information as you can. And I try to summarize what I can in my thematics or industry reports. But on the internet, it's hard to find. Like, where else can you find a good introduction to the Indonesian property market? I can't think of anything other than perhaps sell-side reports.
And just generally speaking, just to wrap up the podcast, what are your best recommendations of, say, books or papers or anything of that sort, just to learn about Asian economy, Asian economics, and in general investing in Asia?
I guess there's an author called Joe Studwell who wrote a book called Asian Godfathers, and I think that's a good introduction to the way business is being done in Southeast Asia. He wrote another book called How Asia Works.
Yep, that's
Terrible
a great
title,
one.
but it's interesting to note. He describes pretty much how most of these countries have developed, and gives you a frame of, I guess, a framework in how to think about the development of East Asian countries. So that's pretty much what comes to mind in terms of economics. Other than that, like in terms of investment-related books, there is not much out there. I mean, there are a few books, but they're not that good. I would just read those American or maybe British investment-related books, like Money Masters of Our Time, like these kind of books. Fantastic, but I guess if you do have access to, there's a woman called Claire Barnes, based out of Kuala Lumpur. She wrote a book in 1994-95 called what's it called again? Asia's Investment Profits or something like that. I forgot the name, but anyway, so that's I summarized that book on a post on my website, so you can read that if you want. That's a picture of investing in Asia in the 1990s. To me, that's highly fascinating. Mark Faber has also written a few books on investing in the region. They're a little bit dated, but Mark Faber's Tomorrow's Gold, I think from 2001, is excellent. Like it gives you this cycle perspective, it gives you context of where we might be, currently in the cycle, and it also has specific focus on Asia, describing all the different cycles that we've seen, over the preceding decades. So that, to me, those books are excellent introductions to the region. Yeah.
Awesome. Is there anything that we haven't covered that you wanted to talk about, or you wanted to cover?
Not really. I mean, you can look at my website for specific stock picks. There's a table of contents with my past picks. I think we covered most of it, but I guess, I mean, broad picture, I know that tech is hot and cryptocurrencies are hot, but like as we've seen in Chinese tech, for example, it's very hard to invest in the most popular industry. It tends to follow these boom and bust patterns, and you do really well for a short period of time, and then you can lose a lot of money, very quickly. So it's the same with cryptocurrencies, and same with perhaps US tech stocks. Just be a bit careful about those. Like I've tried to invest in hot markets, usually failed. Competition is fierce, valuation multiples are high. So I urge people, like, just go to where there's less competition, where no one is looking. And it sounds like Latin America is very inexpensive. I don't know about Africa, but like in Southeast Asia as well, like it's worth it. Just looking a little bit outside of Nasdaq and NYSE, I think is a very good strategy at this point in time.
Awesome. With that, thank you so much for being on the podcast, Michael. It's awesome to have you. I think we had a fantastic conversation. So, thank you for being on.
Thank you so much. Cheers.